All right, so welcome back again. So this time now we're stepping away from chapter 5. Now we dealt with how to make purchases of inventory and how to actually cost it out when we sell our products. Well, here's the next thing that we're going to be looking at is actually selling our products. Because, if we're calculating how much cost of goods sold was, then what about the actual sales process itself? So now I'm going to be talking to you about periodic sales and what this entails. So, of course, with the idea, we are looking at, again, the nature of a business, right? Our main purpose and main goal as of a business is to make some kind of profit, right? It's to make money. And how a company makes money is, of course, if you are selling a good or a service then this is how we actually sell it. So when we look at this, what we're actually dealing with is actually we're looking at how much it costs us to purchase our items of inventory and what selling price allows us to not only cover our cost to purchase the items, but allow us to also make a profit. Okay, so the selling price is actually going to include, the cost of goods sold or all costs to get the asset to the store. And then it's going to include some kind of profit percentage or a profit margin, we call it, okay? So how much is it going to at least give us enough to sustain our company, right? Most profit margins are pretty much geared towards, all right, if it cost me to purchase this item at $1.50, right, and freight was another $25, that's my bare minimum should be around $1.75, depending what it is, okay? Now, if I do that, not only is my cost $1.75, I also have to think about what other factors I need to make a profit for in order to be successful, which is I have to deal with all the other costs that happen in running a business. I got to think about my rent expense. I got to think about my utilities. I got to think about all these other expenses that I have to do, marketing, advertising. I need to make all those I have to make all of those business expenses. So my profit percentage or my profit margin, right, needs to be also focused around, well, if for this month, my rent is $1,500, I need to make some kind of profit margin that allows me to be able to cover that cost as well. So that's usually what the profit percentage or profit margin can be. And you would not believe how large these profit percentages can even go to. So you may buy a product or the merchandiser, right, may buy something for $1 and turn it right back and sell it for $10. Okay, that is a $1,000 percentage right there. Okay. So if you can turn $1 into $10, then yes. Okay. And oftentimes that's what usually really happens, especially when you're doing business. And especially if you are a company that is small, your main goal is to try to get your name out there. But for big companies and major brands, obviously, it's word of mouth, it's advertising. So that's why when they sell a product, you don't care for how much the price is. You just know that they have a good quality to them. So, so there's a lot of different strategies out there to be successful when selling a product, okay? And of course, if you are a store location, by law, it is mandated that you must charge sales tax, okay? Especially on products, okay? A few exceptions will actually are actual produce, right? You guys get tax exempt for buying perishable goods or actually produce, like actual food. And I believe you get there's special taxes for alcohol, tobacco, and et cetera, et cetera. There's a lot of other things out there, but just know that if you are selling a product, you have to charge sales tax, and it's going to be based on the state and the county that you belong to. And we'll talk about that more prevalent in QuickBooks. Okay, but for this, since this was last year, the sales tax has now risen. I believe it's now 8.375%. So it rose by, I believe they said 15th of a penny, something like that. But for now, I just want to keep this class very, very simple. Just understand that sales tax, it will change depending on where you are and what county you belong into. So for now, just for the sake of this class, I want to keep it sweet, short, and simple. So let's just focus on 8.25%. But as you guys know, wherever you do business, your tax will differ. Okay. So with that being said, okay, so now we're going to go look into how to actually journalize a sale. So here we have an example here on June 1st. Okay, 10 items were sold at $9.99 each. Sales tax is 8.25%, so record the sales. So first off, what accounts are you actually going to be utilizing? Okay, assume that this is a cash sale. You actually received cash for this. Cash. Now, is that going to be debited or is that going to be credited?
Debit.
Yes, you always debit cash. Because in this kind of sense, think of this scenario as if this is how the transaction going. When you sell a product, right, you're in exchange, you're taking the product and you're giving it to the person, right? But what are you actually receiving? You're receiving cash. And when you receive cash, you're increasing your assets, right? So therefore, you need to use sales and sales tax payable, and we're going to recognize cash as the first thing, okay? Now the next thing is, because we have a debit already existing, where's our sales going to be?
Credit.
Credits, correct. And if we look at sales in depth, sales is part of your income. Income, if you increased your sales, right, your automatic assumption is that you're going to credit your account, because the idea is that in order to increase your income, you're going to increase it with a credit. So there you go. Now the next thing that I mentioned earlier is your sales tax. Now, I have a question for you. When you receive sales tax, do you own it? Is it yours?
No.
No. Whose is it?
Government.
It belongs to the government. But what you're doing here is when you collect sales tax, you are actually holding on to the money temporarily. And we're going to categorize sales tax payable as a liability because it's not your money. You owe that money to the government. So even if you do pocket that money at the end of the month or at the end of a given period, right, depending on how often you are mandatory to submit your sales tax payments, you need to pay that money back. Okay, so here is we're going to categorize your sales tax payable as a liability. And if I'm increasing my sales, what am I also increasing?
Sales tax.
You're increasing sales tax. If you're increasing the liability, what else? So where do you place your sales tax? It's going to be on the credit side.
Debit.
Credit.
Credit.
Okay. Yeah. So we got sales here. Now, of course, sales is only going to be dealing with the price itself. Now, I was very specific. I said that I charged my item $9.99. I sold 10 of them. So straightforward math, you do 10 times $9.99 to get $999.90. Okay? Now, sales tax is going to be based on your total amount of sales, right? Of course, we'll talk more in depth when it comes to, actually for this particular case, we're assuming that our products are actual products. Like we're not selling food. So that means tax is going to be covered on everything that we sell. So it's going to be based on the sale price. Okay? So if I sold a total of $99.90, how much sales tax am I subject to have to collect or charge?
My total is 824 for 99.90.
$824 for $99.90, and that's correct. Okay. Now, I have a second question for you. Now, in a case where someone goes to the store, right? Are they going to hand you the cash for the sales and the cash for the sales tax separately?
No.
No, they're just going to give you the cash and you're just going to calculate it and you're just going to give them their change back. So in this case, we're going to take the whole amount, okay, of whatever. So we're going to take the whole amount of $108.14, okay? So with that being said, your only job here is you're calculating how much you owe. But that doesn't mean you're paying it right away, right? This is something that this is an accrual account, right? You owe the money, but you're not going to pay it just yet. So here we're just making sure that we recognize that a portion of the sales isn't, or the portion of the cash that we receive, only a portion of it is actually our money. The rest belongs to the government. So just remember that, okay? So here's a perfect example. There it is. We looked at selling 10 items at $9.99, and there was sales tax involved. So that is it. Any questions on how to journalize a sale?
No questions. That's pretty straightforward.
It's pretty straightforward, exactly. All you have to really understand is, well, first off, what accounts you're going to be using and how are you going to organize it, okay? Pretty straightforward. That's why this chapter 6 is fairly easy, and that's why it's only going to take, it's supposed to usually take a whole day to do the whole chapter 6, but I'm going to leave 6.4 for tomorrow, okay? So again, sales process is very easy. This is how you journalize it, and that's it. All right. Now here we have to understand that under periodic inventory, because we talked about understanding how sales affect your inventory, right? But in this case, when we're dealing with periodic inventory, when do we actually record the sales? Or how do we actually know we sold something?
You do the inventory count at the end of the period?
Exactly. We have someone go down to the basement or the warehouse. They do a physical count, and our assumption is that if you started out with this many items and you only had this many items, your automatic assumption is, oh, you must have sold this many items. Of course, that is actually bad because you don't know what really happened, right? You don't know if a sale actually went through or if someone stole it or someone took it for their own, they just took it home. So, but again, this is obviously, if you are taking account every single day, then there's no way that can happen. But we don't even calculate, or we don't even care to keep track of our sales, because at the end of the given period, right, when we do our inventory worksheet, we're just going to assume whatever ending that we took a physical count for, we're just going to assume that everything was sold. So in this case, under periodic inventory, we do not keep track of our sales. Okay, and you're gonna see the difference when we actually dive right into perpetual inventory, which is after the exam. It's in 2 weeks from now. When we see perpetual inventory, we care for every purchase we make, and we also care for every purchase that or every item that we sell. And it will definitely make a drastic change in your journalizing. So in this one, because we're dealing with periodic inventory, we don't care about sales. Okay, I mean, we don't care about recording or keeping track of our sales. We're going to just write that we made a sale, but we're not going to actually update our inventory because we don't care for it yet. We're going to make the assumption that at the end of the given period, when we have that cost of goods sold, then we're taking it out of our inventory. Okay, so there you go. All right, any questions so far? Again, it's pretty straightforward. So that was 6.1. Okay, just understanding how a sale works and how to journalize it, especially using periodic, when you have periodic inventory items. Okay. So with that being said, now, of course, if you're going to have sales, you need to understand that we got customers that, that can return an item, okay? So we have to also deal with understanding how sales returns and allowances work, okay? So again, when oftentimes you sell a product, what happens is that sometimes if you don't check it ahead of time, things could be broken, they could be defective, maybe the product, they don't need it anymore, someone else bought it, maybe it was a gift, that's why they're returning it, or it could be that they're just unsatisfied with the product overall, okay? So of course, this is very general information. As we know, we ourselves are also customers as well, so we know what it's like to be able to return and actually either get a full refund, a discount on it, or even a store credit. Okay, so with that being said, because of that theory, that if we do sell a product, we also have to know that there might be a possibility of a return to happen. So this is why companies must set out some kind of return policy, because the main purpose of our company or our main purpose of having a business is to make sure that our sales are being sold, that our products are being sold and they're not being returned. Because then ultimately, if you have unlimited returns and unlimited sales or whatnot, right? You can expect your customers are going to come back and return every single product that they buy, because they're probably going to use the product and they're going to be like, I'm going to go return it so I can get my money back. Okay, so that's exactly why we need to set up some kind of return policy. Now, oftentimes what you do see on return policies is you can only return them within X amount of days, right? 14 days, 15 days, 30 days, or even, 30, 60, 90 days, right? For those QVC fans out there, I think theirs is 90 days. And that's a long time to try to return something. So, yes. So it depends on if you trust that your customers are going to keep the products, or you want to guarantee customer satisfaction, then, you guys have to just you have to just make some kind of feasible return policy. Now, oftentimes, too, some stores are, sorry, we don't do returns, but we can credit you so then you can continue shopping into our store. And that's one way of getting you to stay in the store and try something else. So they're not letting you have your money back. They're basically allowing you to either exchange, or they're allowing you to just stay somewhere in the company and buy something else. So that's one way of trying to getting to keep their sales being sold. Okay. Other things too is they could even issue a new product if that's the case. Okay. So again, all of these things just come into how you want to sell your items and what measurements you need to take to keep your items sold. So again, some are money back guarantee. Okay. Okay, so again, when you do have the idea of returning these items, if you do charge sales tax, right? If you are one of those merchandising companies that sells items that have lots of sales tax on it, then you have to also consider that you need to also refund the sales tax, because again, that money isn't yours. It's what you're supposed to pay into the government, but it's also the customer's money. And if they're returning a product, then you have to return the sales tax with it, because they're no longer contributing to the society anymore. The whole purpose of sales tax is to charge people for the product that they sell. And if they're returning it, then you must return the sales tax as well. Okay? Because technically it's their money. Okay? So with that being said, let's go ahead and do our example here. We're going to actually practice again making the purchase of the item, and then we're going to go ahead and look at the scenarios on what happens when we actually return the products. So first things here, example, on May 1st, you sold 50 coffee mugs for $5 each. Sales tax is 8.25%. Customer A, okay, we're talking about customer A here, pays with cash for these mugs. Okay, so how are we going to record this transaction?
Debit cash.
Debit cash. What else are we going to journalize?
And then credit sales.
And sales tax.
Yes, we're going to recognize those three things. Now, what is my total quantities that I'm going to be looking into each section here? So how much total sales am I actually going to be collecting? How much total tax am I collecting? And how much total, did I say cash or tax? I think that's, okay, so how much tax am I collecting and how much cash am I collecting? So,
Sales credit is 250.
250.
yes, 250, all right? And because it's coffee mugs, right, our assumption is we're going to charge tax on every single item. So tax is going to be 8.25% of the $250, bringing it to be $20.63. And so I should be receiving $270.63 in cash. Okay. Now, of course, when we're dealing with this, if someone gives us two, let's say they gave us 280, we're not calculating the change either, because we're giving it back to the customer. So we're only recording what the actual transaction was and how much money you're supposed to be receiving. Okay, so $270.63 is what we are receiving from customer A. Okay. Now we're going to go ahead and look at this scenario here. So then on May 10th, okay, customer A wants to return 10 of the coffee mugs for a full refund, okay? All right, and your company's policy was to give a full refund within 15 days. So record this transaction. So if customer A purchased these on May 1st, it is May 10. They came within the window, so that we can actually validate the full refund. So what is going to be our journal here?
Sales return.
Sales returns and allowances.
Allowance. Credit.
Correct. Okay, that's going to be debited. Yes, because essentially what a sales returns and allowances is a contra account. You're not going to undo sales, because sales, you'll learn that sales is final, okay? The only way that you're able to undo a sales is by crediting or debiting, in this kind of sense, another account called sales returns and allowances. And because it's a contra account and the main account to it is sales, it's actually going to reduce your sales. okay? Because it flows in the opposite direction as the main account. So if the main account is credited, the contra account is going to be debited, and it's going to reduce your overall main account, which is your sales. So sales returns and allowances is the first one. Good. What else are you going to recognize? What else are you going to be returning?
Sales tax.
You need to return the sales tax, and of course, however customer A paid you, you're going to pay them back in cash. So let's go ahead and calculate this. If it cost me $5 for each coffee mug, okay, and I'm making a return, a full refund, I'm giving this customer their money back. How much is the sales returns and allowances? How
50.
much? 50, good. And then how are you going to calculate your sales tax based off of this? Are you going to give them the full $20.63 back, or are you going to give them a portion?
A portion.
Yeah,
Correct.
8.25 of the 50.
Good. So how much is that?
$4.
$4.13.
$4.13. So therefore, you're going to be giving back this customer a total of $54.13. So this is how you journalize a sales return and allowance. Okay, well in this case, we haven't talked about allowance yet, but sales return. So pretty straightforward. If you could do it one way, all you have to do is just reverse it the other way when you deal with a returns. Okay, so the same thing as we did our purchases. Remember, purchase returns and allowances. It was the same flow of action as well. When we make a return or we wanted a refund, we just reverse the transaction. Okay, so in this case, understand it the same way as if you were the person and you're dealing with a customer. If they paid you cash, your automatic assumption is you're going to give them back cash. Okay. All right. Now, scenario number 2 says here on example on May 18th, customer A, okay, wants to return 10 coffee mugs for a full refund. Okay. However, but the customer has missed. The customer doesn't like the color. Okay, and you tell them that they missed the return policy. But however, you're willing to give them a 15% discount. How are you going to record this this transaction? So this is assuming that you're a small company, because if you are incorporated or a larger company, your policy is straightforward. You missed the discount period, or I'm sorry, you missed the return policy date. You either are subject to a store credit, or that's it. It's final sale, no returns. Okay, but because if you're a smaller company, you kind of are more lenient, or you kind of want to keep your customers, or you want to keep business with your customers. So you'll throw in additional things just to make sure that you keep your customers satisfied. So in this case, this is a made up scenario where the customer is trying to return something that they don't like. But again, they missed their return policy. They don't want store credit. They don't want anything from you. So, but they're still mad at you, and they're threatening that they don't want to ever do business with you. So you're trying to rope them back in by giving them an additional 15% discount, saying, "I'm sorry, I apologize, but to keep you happy, I'm going to give you a 15% discount." Okay. So how are we going to journalize this time? Sales returns and allowances. Yeah, so this one's going to be an example of an allowance. Yes. Okay. Now, but how much are you actually going to be returning?
$42.50.
$42.50. How did you get that number?
Because you give them the 15% discount off of the 50 instead of the full 50. $50, you're giving them 50% discount.
15% discount. So 40 is a little too high.
Should be 750.
Yeah, I'm sorry,
Only the
750.
15%. Yeah, it's not the. We did the
Yes.
opposite.
Yes, the
Right.
opposite. Yes. Okay, so good. Now, because you're still giving them a portion of their money back, what else is the assumption you also have to give back?
Tax.
Tax. Yes. So, here's one thing that you need to know. When you're dealing with sales tax, it's not based on the quantity of items that you're sold. It's based on the selling price. Okay? So, because this person didn't technically return the items, you still are subject to have to give them tax back. And the tax is going to be based off of the $7.50. Okay? So, because we have the sales returns and allowances, we have to give them sales tax back, and we're giving them cash. So we talked about, you guys discussed this, that it's going to be for $7.50, because ultimately what you do is you're going to figure out how much the actual original cost was. If it's $5 and you sold a total of 10 coffee mugs, right? That's 50, but you're only giving 15%. 15% of 50 is $7.50. And out of that $7.50, you need to calculate the 8.25% of that. So then that's going to give you a total of 62 cents. So that means you're going to be giving that customer back $8.12, even if they didn't even return the product. Okay? All right. Any questions on sales returns and allowances? Okay. All right. So, let me see. Yeah, I'll go cover this last section here. Now, of course, if we also have the idea of having a sales returns and allowance, we're also going to have sales discounts, okay? Sales discounts is one of the fun ones because at the end of the day, what you're going to be doing is you're going to be pulling in people because everybody loves to buy stuff that's discounted. No one wants to buy anything at full price unless it's like a necessity item. But it's always true though. Why do you think a lot of companies, right, they set out marketing flyers, advertising saying that come in now, we have a big grand opening sale, or we have a big holiday sale, whatever holiday it is, right? You want to entice your customers to want to come into your store and purchase your products. Especially, again, no one's willing to pay full price for their items. Everyone's always looking either, especially a lot of people do, what is it? They do shop hunting, or they compare and contrast other people for the same exact product. You know, so you're in that whole mentality where no one's willing to buy your product at full price unless it's an absolute necessity, such as food. Food rarely goes on sale, but sometimes when they are on sale, people buy them out. They buy large quantities because the sale is too good. Okay, so oftentimes this is usually for grand openings, it's promotional sales. Maybe there is a holiday, President's Day is coming up, so there might have a President's Day sale, or it could be a weekly sale. Maybe this week the bananas are on sale, or this week these products are on sale. Okay, whatever it is to entice your customers and bring them in. Okay, so that's one way we can look at it. When you're dealing with an in-store or a store-wide kind of sale, okay, that means everybody is able to get the sales discount, okay? And then there's also other sales discounts that are applied towards whether it's a wholesale, right? If you're a retail and someone comes up to you and they buy you in bulk, you can also grant them a little discount there because they're pretty much a big, huge portion of your business. Okay, so for oftentimes, like I've gone to many little mini shops where they say, oh, you know what? If you buy 10 or more, I'll give you a discount. I'll tax exempt you. You know, whatever discount you want to apply. Okay, those are usually for mom and pop shops. Okay. And then the last one that we're going to be looking at is if you grant your customers or you give them incentives, which we're going to be looking at terms again. And again, your incentive is if they can pay you back on time, you'll give them a discount. Okay, so that's two things that we're going to be looking at as far as looking at our sales discount. But first, we're going to look at our in-store sales. Okay. So first one here, the example here is on June 1st. Your store your store is having, my typo, sorry, is having a promotion on all items are 40% off, okay? And a customer decides to come in and he buys 10 baseball hats with a cost with cash which original price is selling for $10 each. Okay, sales tax is 8.25%. So how are we going to record this sales or this transaction? So first thing that we got to recognize is we are going to be applying a 40% discount because the whole store is 40% off on any item that is purchased. Okay, so now we have to consider the discount. We have to consider the sales, and we also have to consider how the person paid us, and they paid us with cash. So how are you guys going to organize this idea? What accounts are you going to be using? Where are you going to place them? And how are you going to understand this?
Debit cash.
You're going to debit cash. Good. What else are you going to do?
Discount. Debit.
You're going to debit the sales discount. Correct. Okay, so there you go. And of course, sales and sales tax are going to be part of it as well. So this is actually very typical if you've ever seen this before. Because again, when you're dealing with sales is finite. As in, sales is, it's permanent, or it's whatever you determine the price for it to be, that's it. You can't change it, you can't modify it, you can't apply a discount on the actual sales price. You actually have to create a line item or a separate account for the discount, okay? And you can see that when you go to the grocery store, right? Or if you are going to, a clothing store, they have a 40% discount. You're going to see that they're going to charge you full price, and then right at the line under it says the discount for it was XYZ. And then your total cash is at the bottom, okay? So this is going to apply the same exact way. So if we sold 10 baseball hats and they were sold at $10 each, how much was your total sales?
100.
Okay. But if you're taking a 40% discount, how much of those $100 are you actually discounting?
40.
$40. Good. Now, so the assumption is, are you actually receiving all $100?
No.
No, you're only receiving $60 plus the tax. So that's what's going to happen here. Okay. We need to record sales as just as normal as usual, right? This is the assumption, right, that no matter what point in time, even if we're given the idea that we are foreclosing, you must continue doing your sales as usual, as if nothing is different. So that's that concept here. So the sales here, because your original set price was $10, you're going to calculate it as at the original price. However, you're going to create a discount item. So we're discounting the $100 by $40, making our total $60 in remaining. Now, as we talked about this before, when we charge sales tax, are you going to charge it on the full price of $100 or are you going to charge it for the actual sale price of 60?
60.
Yes.
60.
And in this case, you're charging it based on after the discounted amount. So it's going to be on 60 because, again, when you're dealing with sales, it's based on the actual sales that happens. Like how much the customer is giving you is going to be based on that amount. Okay? Yes, it's going to be based on that amount, not the actual original price for it. Okay? So, sales tax. Okay, I'm going to talk about this as well. Sales tax can never be discounted. Okay, oftentimes we always say, "Oh, 10% is pretty much covers the tax." Yes, it does cover the tax, but it's not paying for the tax in another sense. You're still going to be subject to the tax no matter what it is. So again, in this case, since sales tax can't be discounted, that is exactly why you're going to discount the original price first and then charge the sales tax after that. Okay, so everything has to go in order. And then lastly, we figure out, well, how much cash am I supposed to have? How much cash am I supposed to be receiving from this actual sale? And it's going to be $60, okay, plus the tax, which gives you $64.95. And if you calculate it, both sides match on each side, okay? So this is very crucial that you understand this as well. We record the discount at its original price. We figure out how much the discount is for. Then we calculate how much tax is based off of the sales minus the discount. And then we find out how much cash we're actually supposed to be receiving. So this one's a step by process, and determining what comes first and what comes next. Usually this does take a lot of practice, so I don't blame you if you decide, oh, okay, a sales has happened. I'm going to recognize sales first. Okay, so that's why I encourage you as beginners of this to work on a scratch piece of paper before you actually enter it into an actual journal. But for this class, since we are utilizing either Word or Excel, you guys can fix it at any time. Okay, so that's how we deal with in-store sales. Okay. Now, what happens when we're dealing with a customer that owes us money? Okay, so let's look at this scenario instead. So on July 1st, right, a customer wants to buy in bulk 100 baseball hats from your store, okay, on an account. Okay, so make sure you understand that this is going to be an accounts receivable. Okay. Okay, so because this customer is a first-time buyer, you offer them pretty much terms in which it's going to be a 5% discount if they pay within the first 15 days. If not, then they have to pay the whole thing in full by 30 days, okay? Okay, and each hat is sold for $10 each. Sales tax is 8.25%. So, and we tacked on a delivery charge as well for $10. So, all of this is because this person decides to come into the store. They say, I want 100 of those. Okay, we don't have 100 available, but I can ship it to you if you want them. And because you're a first-time buyer and you're going to place this on account, I'm going to give you an incentive. If you can pay me back in time, within 15 days, I will give you an additional 5% discount. Okay. So with that being said, how are you going to be journalizing this? So let's lay our foundation first. Let's actually discuss what accounts are going to be used and how we're going to place them down. What are we going to be doing? Accounts receivable. Good. We're not receiving any cash from this guy. It's going to be accounts receivable. Okay?
Account receivable debit.
Mm-hmm.
Discount.
Did you say, what did you say?
Sales discount.
No discount.
No discount.
Not yet. because we have terms. He didn't pay us yet. So sales tax.
Sales tax.
And freight.
Okay, freight. We're going to change it
Delivery
around.
charge.
Shipping charge. Good. Okay. So good. We're gonna recognize that he's gonna owe us money. So therefore, he's not paying us now. He's gonna pay us later. Okay. And the concept here is we give him terms. If he pays within the first 15 days, then we'll grant him the discount. But if he doesn't, then he has to pay the whole thing in full. Okay? So now we're going to calculate how much the actual sales was. If he bought 100 hats at $10 each, what's my total sales going to be?
1,000.
1,000. Okay? And out of the tax there, how much tax is he going to be, are we going to be collecting from this guy?
$82.50.
$82.50. And then how much was the additional delivery charge?
$10.
$10. So our grand total here is it's going to be the $1,000 for the sales, right? He's attempting to buy all 100 items. All 100 items at $10 each. Okay? Tax right there is going to be $82.50, and we tacked on a delivery charge. Okay? Same thing here. Freight, any delivery charges cannot be discounted. Okay? You could do free shipping, that way you just don't charge it at all. But in this case, I'm going to charge him an additional fee because, 100 baseball hats, they get heavy when you pile them all together. Okay? So we're not willing to take that discount, or we're not willing to give him free shipping. But we are charging him though. But we're willing to give him a 5% discount if he pays off this $10.92.50. Okay. So good. Now here's the scenario here where on July 12th, so it's been 15 days. It's within 15 days. Now the customer pays us, okay, for their purchases in full, okay? So now we have to record this transaction, okay? And the terms were, again, 5%, 15, net 30. So now that we have someone that has an accounts receivable with us, we're giving them an incentive to say, hey, if you can pay me back the money on time, I will give you a discount. So because he did meet the discount period, how are we going to record this transaction now? Let's go ahead and talk about what accounts you're going to be utilizing. He's paying for our... Okay, so cash, okay, but usually he'll pay with either cash or checking. Okay, good. We got that as a debit.
So sale tax, and we have to put discount on that too.
Yeah, okay, good. We're going to do the sales discount, and we're going to recognize that we have to give back sales. Good. And then what's the last account that we should be recognizing?
Account receivable.
Correct, because he's paying for what he owes us. If he owes us on an accounts receivable and he's paying us back, we have to essentially reverse that transaction, or we have to zero it out. And in order to decrease an accounts receivable, we credit it. Okay? And the notion here is we're receiving cash, but are we receiving the full amount of the 1092? No, because he received a 5% discount. So this is where we're going to have to do a little mental math here, or go on the side and actually calculate this. Now, if we know that this terms, the 5% discount, what number are we actually applying that on? What total are we applying that on? Are we doing the whole total 1092, or are we doing it based on the total purchase price?
Total purchase price.
Total purchase price, which was $1,000. So if you can only discount that 5% off of that $1,000, how much are you actually refunding? or in this kind of sense, how much are you discounting? Sorry.
It's 50. Discount is 50.
Mm-hmm. Good.
1,092.50, right?
Yes, it's 1,092.50.
1,042.50 total.
Okay. Now don't forget, we also have to calculate the tax.
Tax going for 50.
The tax is going to be on the $50. Yes, correct.
4
$4.13.
Correct. So if I know that I owe in grand total $10.92.50, I'm discounting the product by $50. I'm returning a portion of the sales tax. So how much am I actually collecting?
1,038.
Okay.
Good.
Okay. Good. So again, this one has a lot of thinking that you have to do. Again, you can only take a discount off of the original selling price. You can't take a discount off tax. You can't take a discount off of the shipping or freight or handling, whatever it is. It has to be on the original selling price. So in this case, we recognize that it was the $1,000. We take the discount of 5%, gave us $50. And from those $50, because that's the amount that we are refunding, or in this case, discounting, right? The customer's not going to pay the full tax. We have to give them back the tax, okay? Or take off that tax. Now that we figured out it was $4.13 off of the $50, then how much is he really going to pay us in? He's going to pay us a grand total of $10.38.37. Okay, even though it matched how much his grand total amount that he owes us, which was originally for the $10.92.50. Okay, so that's that there. Any questions on how to deal with customers that when you give them incentives such as terms versus a in-store discount? Okay, so difference is one of them is paying at time of purchase. This one is paying after the purchase. Okay. So course review here is today we talked about how to deal with sales. We talked about what happens when we record a sale. We talked about what happens when a customer decides to return something. So we looked at a returns and an allowance. Okay. And we also looked at two different types of discounts. We have an in-store wide discount, which is widely used. And then we also have ones that you can personally give incentives to if you give them terms. Okay. So one of them is in-store and the other one is when you give special discounts to people who owe you on an account. All right. And that's it for chapter 6.1 all the way to 6.3. Any questions? Okay. If there's no questions, I'm going to go ahead and call break right here. So right now it is exactly 10:10. So go ahead and take a nice 20